This Christmas, you will be driving home, not in your car, but in the same car that you have been using to run company's errands. But this time around, you are not using it for official purposes, but for personal use, visiting friends, and celebrating the season. As you do that, I want you to understand that benefit that you are gaining from using a company's car to run personal errands, visit friends, and enjoy the season, it is referred as a non-cash benefit. Even if you are not being paid cash by your employer, there's some economic value you are gaining from your employment. And as I keep saying, there's nothing for free in Kenya. KRA expects you to report that extra benefit and have it taxed alongside your other employment gains from your employer. But now, most employees and employers, they get it wrong. They don't understand using a car facility for personal errands is a taxable benefit, and they usually ignore that, and hence they get taxed, penalized, and fined by KRA. I don't want that to happen to you. So, what is a non-cash benefit? A non-cash benefit, according to the laws of Kenya, are any advantages or gains that you receive from your employment, even if they are not coming to you in cash form, they still provide an economic benefit to you as an employer. This could include the car that you have been given by your company to run company errands and also personal errands. It could also mean that you have been provided by a residential house by your employer. If that is the case, then consider it to be a non-cash taxable benefit that should be declared whenever you are filing your pay-as-you-earn returns. Of course, I cannot leave behind the low interest or interest-free loans that you get from your employment. Those are non-cash benefits. If you are not employed, you would not have received those benefits. So when the employer is filing for you the pay-as-you-earn returns, if you have been paid 100,000 and you have received an non-cash benefit to the tune of 10,000 as value, that 10,000 should be added to your monthly salary, and 110,000 in total should now be subjected to the graduating tax scale for purposes of computing how much pay-as-you-earn you should pay to the government of Kenya. Now, why are we saying that if you are using a company car to run your personal errands, to take your children to school, to go for Christmas, visiting friends and relatives, and enjoying the warmth of the season is a taxable benefit? Why is that so? The reason why that is so is because you are enjoying some cost savings. If you did not have that company car, you could have bought your own car. So the cost and the money that you would have used to buy your own car, you are using it to do something else. Perhaps you would have taken a loan facility to finance that car, and that loan facility would entitle you or subject you, require you to pay some interest expense. This time around, because your employer is very generous and kind, you are not paying such interest loans. If you were not given a company car, probably you would have paid for fuel. You are driving your own car, you would be fueling. But now, because it is a company car, you don't incur the fuel cost. So it goes without saying that is a benefit. You are saving that fuel cost. Or if you would have just taken a public service vehicle to travel up country with your family, you would have paid transport fare. But now you are not paying because you are driving your own car. Insurance cost. If it was your own car, you would have paid for insurance premiums, either comprehensive or third-party insurance policy. But this time around, none of that is coming your way. Repairs and maintenance. Maintaining a car is not easy. It is costly, and that's why normally we refer to a car as a liability and not an asset. But now, this time round, your employer is the one who is doing everything for you. Remember, we discussed recently the concept of moral hazard, where the doer of the action is not responsible for the outcome of his actions. So, as much as it is your employer who is taking care of everything in terms of the repairs and maintenance of that car you are driving home this Christmas, don't misuse it. Because those costs, the repairs that might come up as a result of improper use of the car, someone will take care of it, and that is your employer. So there's that aspect of moral hazard. But nonetheless, the wear and tear, the depreciation for the car you are riding is not on you, it is on your employer. And therefore, it goes without saying that using a company's car for personal errand, to drive home, to visit friends, relatives, enjoy the season, it's an employment benefit. Though it is a non-cash, it is still taxable. And how is it taxed? By KRA. KRA uses two options. Option number one is they compute 2% of the value of the car that you have been provided by the company to know what non-cash benefit you are receiving and enjoying from your company. So let's assume that the value of the car that you are driving is worth 1 million Kenya shillings. Don't know whether it is a premium or whether it is a pro box, but let's assume it is 1 million Kenya shillings. KRA requires you to pay 2% of 1 million, or it calculates the benefit that you are receiving from the use of that car as 2% of 1 million is 20,000. So this 20,000, if your monthly salary is 100,000 and you have been provided a free car by your employer, the 2% of 1 million, which is 20,000, is considered as non-cash benefit. So your employer, before they compute for you the pay as you earn, they say you earn a salary of 100,000 plus the non-cash benefit of 20,000. That makes it 120,000. They now subject the whole of 120,000 to the graduating tax scale. The way we say the first sum that you receive between 0 to 24,000 shillings, it is taxed at a flat rate of 10%. Anything above 24,000 but below that 2,333, it is taxed at a rate of 25%. And anything above that 2,333 to the now 120,000 that I'm talking about, it is taxed at a whooping rate of 30%. Your accountant or the employer computes all that and remits it to KRA. If that is clear with you, then that ride that you feel or think it is for free, it is not for free. At the end of the day, you are paying for it. And why is that so? This is because KRA does not consider anything to be for free. And for any expense to be deductible before computing the taxable profits, then that expense must have been incurred wholly and exclusively for purposes of generating income revenue for the company. Why am I saying this? This is because the company will be fueling your car. The company will be paying insurance for your car, will be doing repairs and maintenance, will be doing everything that your car needs to be done for. And at the end of the day, the company will recover or deduct these expenses from their revenue so that they can arrive at the taxable profits. And that taxable profit is the one that will be subjected to that % corporation tax. Now, why is KRA allowing the company to deduct expenses for fuel that you are going to travel up country? And that fuel is not being used by the company for purposes of generating income. It is not used for doing production for the company. It is for personal use. And remember, for any expense to be considered tax deductible, it must be wholly and exclusively used for purposes of producing income or making production for the company. But this one, the one that you are using to go to the village, if the company does not get taxed, because the government, the KRA will just consider all these expenses that are incurred by the company wholly and exclusively incurred for purposes of generating income for the company. So the company gets exempted from paying those expenses. From the company's perspective are deductible. But when it comes to you, because you know very well you used that fuel for personal use, the tires, the wear and tear, all that was caused by you going for Christmas, you have to pay for it. Usually, ordinarily, if the company gets exempted for some expenses, those expenses being deducted from the revenue of the company before arriving at the taxable profit. If those expenses are deductible from from employer's perspective, the same expenses cannot be taxed cannot be perspective as an employee. Now that is clear. What do you need to do so that holiday ride that you are enjoying, using and cruising with a personal car that is owned by the company, now you have converted it to be your personal car? What do you need to do so that when you come back in January, you don't receive a tax assessment letter from KRA? This is what you need to do, both you and your employer. You need to understand what is the value of the car that your employer has given you and what is the engine size. Because in fact, when KRA is computing how much cash benefit you are receiving from the use of the car, they check the higher of the two, either the 2% of the value of the car or using the prescribed rates regarding the CC or the engine size of the car that you are driving. For instance, if you are driving a car that has an engine is between to 2000 cc, the amount of money that you are supposed to be the amount that is supposed to be considered as non-cash benefit to you is 7,000. So in a year, we are talking about 7,000 multiplied by 12, that is 84,000. But for the case, the one that we are doing on a monthly basis, so 7,000, because the car that you are driving, the CC engine size is between 1,700 to 2,000. The prescribed rate by KRA for non-cash benefit is 7,000. Now, that 7,000 you compare with the 2% value of that car, which we assumed it is 1 million Kenya shilling. 2% of 1 million is 20,000. So KRA, when it comes to the issue of benefits that they need to tax, they take the higher of the two. Between the 20,000 and the 7,000, which one is higher? So from KRA's perspective, of course, 20,000 is higher. And that's why they use it instead of 7,000 to say this is the non-cash benefit that you are getting or deriving from the use of that company car for personal errands. So what do you need to do? You and your employer, you need to know what is the initial cost of this car that have been given to drive and what is the engine size. So you compute the 2% of the value of that car, and also you check the prescribed rate according to the engine size for non-cash benefits. Whichever is higher is the one that you will use to add on top of your salary. It is subjected to pay as you earn tax. Once you do that, then ensure that you separate the business and personal use of the car. If the car, you're using it 50% for business and 50% for personal use, then when the 20,000 that we have spoken about, the 2% of the value of the car, which is 1 million, 2% of 1 million, 20,000. If you are using this car 50% of the time for 50% for personal purposes, then the 20,000 you will not, then it means you are not getting the value of that car 100% for personal use. It is 50-50. So it's only 10,000 that will be added on your pay to compute, for purposes of computing your pay as you earn. Remember, this car, if you go with it home, every other evening you drive home for purposes of, again, going back to the office in the morning, that is personal use. If it is available to you the weekends, if it is a car that you use to drive your children to school, and it is registered under the name of the company, even if you are the director of that company, that is a non-cash benefit that you are receiving from your company. Remember, as I keep saying, there's a difference between you and your company. According to law, you are two different, distinct persons. The person that you are as the director, the founder of that company, and the company, you are two different individuals. Remember, Steve Jobs was fired by the same company that he helped to create. And I've seen people that have been sued by same companies that they created. So you are two different people. Just because you are the only shareholder and director of your company, it doesn't mean when you are driving that car that is registered under the name of the company, it doesn't mean that is not a non-cash benefit. It is, and you need to treat it as such. So if that is the case, ensure that the value of the non-cash benefit that you are deriving from the use of that car is added on your salary before that pay is being subjected to the graduating tax scale. Always avoid under-declaring, because KRA is watching. If you under-declare the value, you can imagine if the car that you are driving is worth 3 million, 2% of 3 million is 60,000. So on top of the salary that you are allocating yourself, you are supposed to add 60,000 as a non-cash benefit that you are receiving from your company. So if your salary is 100,000, that's another 60,000. So if you feel that this is so hefty for you, so heavy for you, that KRA is exploiting you, then refuse the offer. When the employer gives you that offer of a car, now with this understanding, politely say, no, thank you. I don't want that. Because at some point, KRA will catch up with you. Remember the long arm of the law. Finally, and now that you know better, I expect you to do better. As you cruise around, enjoying the holiday ride of this festive season with this company car that is giving you convenience and making sure that you move smoothly from point A to point B as you visit your friends, relatives, and run other errands. Just know you need to make the right choices, to take the actions so that you don't yourself on the wrong side of KRA. This peaceful, joyful ride that you are getting can easily turn to a stressing and a source of headache when it comes to tax issues and complications between you and KRA. So as you enjoy the festive season, as I wish you a Merry Christmas, just ensure there's nothing, just remember, there's nothing for free as far as KRA is concerned.